Hello there, traders. Welcome to today's live stream. It is Thursday, the 9th of January. No US session really today. We have the funeral of former president in the US going on today. So the US session might be a little bit light. I know equity futures are going to slow down or close a little bit earlier today. I know a few markets aren't open. So might be a little bit of a slower session today, but we're going to go over our usual stuff. We're going to have a little chat about what's happening in the market right now, what's happened. Also, we're going to be talking about some key markets to be keeping our eyes on. There's a big story at the moment in the UK right now. We've had UK gilts, which is basically UK bonds, falling quite aggressively to similar levels that we saw when Liz Truss announced the mini budget, which has seen UK yields rise aggressively as well. So we can have a little discussion around that. We did talk about the potential for some pound weakness in the market, so that was reflected on the currency strength meter from last week. So we were looking at potential pound shorts going into this trading week anyway. This story has helped kind of bring that a little bit more to light. So I like the idea of being short pound at the moment, but we're going to be having a look at that against some of the markets. A couple of markets that we quite like the look of was a pound Kiwi, I think we discussed earlier in the week. That was brought up by one of you guys, and we had a little discussion about that, and price has continued to have a little fall there. I quite liked Kiwi Swiss, but nothing has presented itself here just yet. But other than that, we're going to go through a few of the big stories that's going on at the moment, and like I said, that one really being the 10-year yields in the UK rallying quite aggressively. So hi guys, let me know what you're up to today. Let me know what markets you are potentially having a look at as well. Welcome Harmy, hope you are doing well. Hope you've had a good and successful trading week so far. So yeah, I'm still in two positions in the market at the minute. I'm in a dollar Swiss position long, and I'm also in a silver long position right now. Silver doing okay, dollar Swiss not so much. Like I say, I'm in profit, but it's just kind of holding at the previous swing highs at the moment. So I need to see price really try and elevate through that level in order to me to kind of warrant holding on to this position right now. I feel like for me, I need to see at least kind of break through the 91.40s before we see any kind of movement there. So I'll keep an eye on that one at the corner of my eye as we go through today's session. So yeah, hi guys, let me know in the chat if you can hear me okay. My microphone has been playing up a little bit today, so hopefully you can hear me. And we'll get on to some of the big stories in the market, as well as some other potential opportunities. We did discuss a few commitment to trade report signals as well that we are keeping our eyes on. Now, I haven't actually updated the currency strength and weakness table for a couple of days because I've been in two trades. Usually I don't like to add too much risk into the market at once, so I haven't actually updated these. So I do need to go and sort of do that, so I'm just going to highlight that up there. So let's just quickly kind of dive into that as well while you guys get up to speed with what's going on in the market. So dollar index has two bullish close Monday, Tuesday and Wednesday, so I can add that to our currency strength meter here. Let's see how euro closed, and that's likely going to be two bearish closes. Pound as well. This is the sell-off that we've seen in the pound at the moment after breaking that sort of 125 handle. Market is moving lower. Thank you, Harmy, for letting me know that you can hear me okay. This market's pushing a lot lower here, which is quite interesting. On the weekly chart, I pointed out this little bit of a level in the week ahead, where we had this zone in there where we could either anticipate sort of a slight rebound back up into the resistance level before seeing a sort of continuation to the downside. Looking at the daily chart, that's kind of what we had, but Friday was this sort of low inside candlestick. Then we had a very strong bullish close into the resistance on Monday, Tuesday the rejection, Wednesday, Thursday we've seen that sort of continuation. So 123 is the barrier for me. If we can breach 123, then 121s look pretty good for cable right now. So we'll see if we can see that kind of continuation to the downside here. But yeah, we've got two bearish closes over there. Dollar CAD was another interesting market that we discussed. We've had two bullish closes here, but nothing really moving in terms of dollar CAD at the moment. Dollar Swiss. So I'm in long on dollar Swiss. If we just pop to the 4-hour time frame here, I got in long on this breakout candlestick here. My target is towards the kind of 92 area, 0.92. Market is pushing to the upside here at the moment, but you know, it's kind of holding at this high, which I don't mind, you know, because we've come up into this high. We haven't really seen a strong rejection away, have we? We've seen a market that's kind of come up into it and holding at it. So usually if a market comes into a resistance and holds, then there could be a good chance of a potential breakout. So that's what I'm hoping for anyway when it comes to dollar Swiss. You know, my stop losses at the moment are below these lows in here. Mental stop is if we start to make new lower lows. So, you know, if the market kind of comes in, starts to make a new low in the market, then, you know, I'll exit my position in that sense there, because I want the trend to continue here for dollar Swiss. But we are coming to pretty much a high, essentially towards that 92 handle. Hi, Bongo. Hope you're doing well, mate. Welcome to the stream again. So let me just go through and fill in a few of these bits, and then I can bring the currency strength meter down. One market that was considered to be a opportunity for us going into this trading week was Euro Yen. Euro Yen starting to kind of make the sort of the right idea, I'd say. The only thing I would say at the moment is we didn't quite get the setup that I was really looking for, but you can see we actually came up into this kind of area of resistance and moved away from it. But I will come back to these. I'm just going to have a little look to see how they closed over this week, because there was a few opportunities that I've kind of missed out on by the looks of things, because I'm already in two positions in the market. So pound CAD was another one of those which we were looking to potentially sell, or the currency strength meter was telling us to sell anyway. Swiss yen had one bullish close on Wednesday. So and just if you're looking confused right now and you've joined the stream and you're like, what are you doing? I'm basically filling in my currency heat map because I haven't been able to keep up with it, and I haven't put in the closes of most of these. Okay, so I'm going to go in and pop those in now. So yeah, there was a few ideas that were kind of floating around when it comes to currency strength and weakness going into this trading week. Again, this is just my personal tool. This is something that I created for myself to give myself direction in the markets. You can make one of these yourself. I've got videos on the channel of how you can do that, so please feel free to go back and have a little look. Just search currency strength meter blueberry markets and it will probably come up. But yeah, essentially this is what I was kind of looking at going into this trading week. I mean, pound was definitely a market that I probably should have focused a little bit more on by the looks of things. If we go take a look at what happened to the pound. So we had a pound Aussie short opportunity, pound Kiwi. Actually, we missed the pound Kiwi one. I was meant to put the pound Kiwi one down, and pound CAD. So let's go take a look at those pound, because pound has taken up a large proportion of the sort of market at the minute in terms of the stories, right? If you go take a look at Bloomberg and things like that, you can see pound is all over it at the moment. And the reason being is because we've had this sharp decline, and we've now reached levels where it's been the lowest level it's been since sort of last year. and is heading towards sort of 2023 lows. So there's a big sort of story around the UK at the moment that the pound is a weak currency, and we're going to see that it continues to be a weak currency. A large factor of this as well is to do with the fiscal policy out of the UK. So you have fiscal policy and you have monetary policy. Okay, so fiscal policy is anything to do with your governments, right? So they tend to lean into sort of, well, government spending and your taxes, for instance. They have like kind of two tools they use there to try and help an economy. And then you have the monetary policy, which is your central bank, which is the Bank of England, right? Now, the Bank of England's mandate is to keep inflation low and to keep full employment. That's what a central bank is there to kind of do. And they can kind of control things by changing the interest rates and controlling the money supply, essentially, is what a central bank is there to do. Now, from a UK point of view at the moment, there's a very big risk of what is known as stagflation. Let me know in the chat if you know what stagflation is, or if you don't, I can explain it to you. So let me know in the chat if you know what stagflation is. And we can kind of talk about what's happening within the UK. But this is a big kind of story at the moment within the UK. Bongo, please look at Euro Aussie. I think it's almost ready for shorts. Also, Euro dollar analysis, please. Yeah, I'll jump onto that straight after the pound analysis. We'll go take a look at that one. But yeah, let me know if you know what stagflation is. Don't worry if you don't know what stagflation is. We're all here to learn, and you learn something new every day. So for those that don't know what stagflation is, it's essentially when you have higher inflation, but you also kind of have higher sort of higher unemployment rates as well. But also, it's almost like how can I give you an example of this? It's essentially people will start to prioritize other things. So I'm trying to think of a good example. Let's say price of goods. Okay, so the price of goods, so inflation, right? The price of goods have gone up. The cost of services have gone up, but they're not necessarily coming down. But you've also got people and the consumer spending, they're not meeting that demand essentially. But prices aren't coming down with the weakening of that demand. So let's say you've got prices, let's say you're a shop owner, okay? You are selling chocolate, right? For whatever reason, you're selling chocolate. And because the price of cocoa's gone up and inflation's gone up and X, Y, and Z, the price of your product has gone higher. So you're selling chocolate and your demand is being met. So that's why your prices are going up, because you have demand for your product. All of a sudden that demand starts to disappear, but you can't bring your prices down because the cost of everything is also too high, right? To try and bring into that meeting of the supply and demand. That's essentially what stagflation is, and it's quite a bad thing for a market to go into. You don't really want to be a market that's in that sort of situation. You have sort of deflation. Now, deflation is when your consumer price is coming down, okay, and the costs of goods and services are coming down. Inflation is your costs of goods and services are moving higher. Stagflation is your costs of goods and services are kind of staying the same, but no one can really meet the demand, the threshold for it. So you're in this kind of stuck position. That's where the UK kind of rests itself at the moment. The reason why that is a lot to do with the fiscal policy in the UK at the moment. So there's a lot to do with the Labour's budget, and Labour's budget is something that the bond market in the UK doesn't agree with. So if you were to go to something like, so UK gilts. So the gilt market is the bond market in the UK. Okay, so if you type in UK 10-year, there's the ticker for it, 10-year BGBP, UK 10-year gilt, right? You can see that this is moving lower. Okay, so this was the Liz Truss situation right in here. This was the little Liz Truss mini budget scenario where we had gilts slip, or bonds, sorry, I'll just call it bonds. Bonds slip quite aggressively, and that then axed sort of Liz Truss out of Parliament, right? Now, Labour have come in and, you know, we are seeing gilts slide to levels where, you know, beyond sort of where Liz Truss was in, right? So you can see that sort of 91.58 area there. So basically there's a little bit of a panic now going on in the UK, and we're seeing yields rise aggressively, and they're at levels we haven't seen since 2008. You know, if we go look at the gilt market here, you know, they're at levels we haven't seen for a long time. I mean, you can go further back in this chart. I'm pretty sure it's 1998 we haven't seen them at these kind of levels. And if we go to the 10-year yields, you can see we're up at 4.86%. The last time we were kind of in those areas was 2008. So at the moment, the market is trying to price in that sort of risk factor that essentially the fiscal policy from the Labour government is less government spending, more taxes, right? Which kind of contracts the economy in a way. Then you've got the factor that the Bank of England then have to come in and try and kind of balance that. But the problem is with the Bank of England at the moment is inflation is too high for them to want to cut interest rates. So I think we're going to get to a point here where the lack of growth, which is something we've discussed on the channel for a while, okay, in the UK, this is one thing that we discussed. If we go and take a look at our trading economics chart that we like to always have a quick little look at, you know, if we go over to trading economics, okay, so you've got a little bit of a sort of summary here as well from trading economics. It can just say here the yield on the 10-year gilt surged to 4.8%, the highest since August of 2028, while the yield on the 30-year gilt climbed to 5.4%. Okay, so it's the 30-year bonds where we had it the highest rate since 1998. The rise reflects a broader increase in bond yields fueled by concerns over Trump's policies and hawkish outlook from the Fed. The pressure in the UK bond market has been further amplified by mounting investor concerns over the nation's debt levels and the government's ability to restore public finances while implementing its budget plan. So this is what I was talking about. So the Chancellor Reeves essentially wants to put up those income taxes and spend less on government spending, basically. So you can see here the Chancellor of the Exchequer unveiled a new budget that included $142 billion in borrowing and $74 billion increase in annual spending, raising alarms about fiscal sustainability. So that's why we're seeing this move in the gilts right now. Now, if we go over to countries and we go to the United Kingdom and we go to GDP, hit on GDP here, and we go to GDP growth rate, you can see that we're at sort of 0% for Q3 of 2024. So it's not great. If we go over to the forecast of what's going on in the UK as well, we're forecast to grow to Q2 2025 0.4%. So it's not the best, you know. Back if we go look in Q1 of 2024, we're at 0.7. We had quite a sharp increase from sort of 2 quarters of lower GDP, which is a technical recession there. We had a strong growth in Q1 of 2024, but since then we've just kind of depleted off, and future growth is not really there either, which is a big reason why I thought that the UK was in a little bit of trouble. Because what does low growth kind of incentivize? Well, it will incentivize potentially from the Bank of England interest rate cuts. And if we go and take a look at what's going on in the UK when it comes to indicators, right? So we go indicators, interest rate. We go take a look at the United Kingdom. We're still fairly high. We're at 4.75%. So across sort of multiple assets and multiple markets, the UK have actually held their interest rates a little bit higher than most. You know, if you go and compare that to the likes of Switzerland, for instance, you can see that the Swiss have been cutting interest rates aggressively while the UK haven't, right? So that's why, you know, you could look at a pound Swissy chart, although it's kind of gone a bit sideways over 2024, it has been quite bullish. Same with the likes of, you know, pound yen, for instance. So people were kind of favouring the pound because they were leaving interest rates a little bit higher. If we go take a look at prices here and we go to CPI, which is our inflation, okay, inflation rate month on month came down to 0.1%. That's not bad. But we want inflation rate year over year. So the inflation rate year over year is actually rose to 2.6%. So remember, the sweet spot for a central bank is this kind of 2% level, 2% and below. You know, I think 2.3% is not sort of that bad either. Kind of give yourself a little bit of a margin for error there. 2.6%, a little bit higher. You know, what's really driving that? Well, energy prices are starting to go up, and energy prices have a sort of bullish impact on inflation. But you can see kind of over the period of the last 3 months that inflation has started to sort of creep up higher there. Although we haven't got December figures just yet from the end of last year. So yeah, it's very interesting, the situation in the UK at the moment. I think this would be an alarming figure if you go and look at sort of core inflation rate year over year as well, up at 3.5%. Again, that's fairly high. If we go take a look at a 10-year chart, you can see that, you know, in 2017 the peak was 2.7. You know, then we had that inflation rate. Now core will take out your energy and things like that. So energy and food prices, because they are more volatile. And you can see that this isn't really at levels where you would want it to be at either. So the Bank of England have been holding interest rates higher to try and bring these prices down, essentially. Because a steady rate of inflation is 2% per year, where, you know, at some points we were at 5.9% compared to the previous year, 6.8%, and so on and so forth. So yeah, the UK have got a really interesting dilemma on their hands right now. They've got a fiscal policy which isn't really there for growth, but you've got inflation that's a little bit higher. So the Bank of England are leaving rates higher, but the problem with that is that it could then mean that people aren't going to go out and spend. And what is an economy run on? It's run on spending. You know, if you go and take a look at, you can have a little look at your money supply here, which is M2. You can have a little look at your money supply there. An increase in money supply is typically good. But you can also have a look at consumer, right? Consumer spending. How's consumer spending going in the UK at the moment? But really speaking, you want to take a look at your retail sales month-on-month figures, right? And you can see it's not been particularly great either in the UK. So yeah, UK is looking pretty bearish. You know, that can be seen from the currency strength meter here. We were looking for that -5 there from the previous week. Pound Aussie, pound Kiwi, pound CAD, pound yen I don't mind actually. I'm a big fan of buying yen right now, but I'm not in it just yet. But, you know, looking at a potential opportunity there could be is pound yen. You know, we're up at this area of resistance at the 190s. We've had this nice rejection here yesterday. So that was a nice close there. Get rid of that now. Sorry, that was Monday. This is a weekly chart, sorry. Wednesday, we had that nice bearish close. Tuesday actually closed as a little bit of a rejection from those highs as well. So actually, this looked pretty good. I haven't managed to get into pound yen, but that actually looks pretty good for a little bit more downside, I would say. I'd be looking at this kind of 194 handle now, where prices has found a little bit of support in the past. We can see that 194 there. You know, if we can close below that, that could open up a little bit of a door for us for any kind of downside at the moment. Hi, Yasuti. Maku just logged in. I've got a few questions. Yeah, fire away. Hi, John. How are you? I'm good, thanks. Just nothing. I hope you're well too. Do you believe global growth of Chinese car maker BYD poses a significant challenge to Tesla's market dominance? Absolutely. I think what China tend to do is when they want to try and capture a market of something, they come in and they do it cheap. So they give everybody, it takes that sort of mass adoption up. When I think of like Temu, right? Temu's a big Chinese sort of seller, retailer, similar to what Amazon is, I guess, and they are trying to integrate with social media. And I think that's where the next sort of step is going to be, is you're going to be buying stuff through social media direct rather than having to go to a separate website or a separate store to go and do that. And I think Temu are trying to capture the market on that at the moment, but they're doing it because they can give superior discounts in the market. I don't really use Temu. I don't really like using it. I don't think it's a very good app or product or the products that they sell. But my granddad uses it all the time. He absolutely adores Temu. But yeah, just coming to this, I do think that it'll pose a significant challenge to Tesla's market dominance. But the problem that I've got with Tesla, and we kind of discussed this on Tuesday, Tesla's price is, I think, very much overvalued. The market is starting to come down a little bit here from those highs. But, this was when President Trump was announced, and the market went on an exponential run. And then obviously he was announced as being part of the Department of Government Efficiency. Check me out, remembered that. And that also influenced the buying there, the stock market, of the stock of Tesla. Tesla's got a weird kind of... I would say you don't just buy into Tesla. If you're buying the stock, you're buying into Elon Musk, right? You're buying into the person. I feel like that's what Tesla's a little bit about. And it's got a bit of a different following to the likes of, BYD. BYD is, the car manufacturer. I think BYD can probably take the market off a few other competitors. Maybe, you got the likes of Polestar and stuff like that, that are just purely electric manufacturers. What's the other one as well? Is it Rivian or something like that? Maybe BYD can probably take the market from those. Don't think it will take the market dominance from Tesla just because it's got this kind of cult following. And also Tesla are like, I reckon they're just going to go down the route of creating like concept cars. When you think about the Cybertruck, it's not really I wouldn't say that's a practical vehicle, right? But, I mean, I've never driven one. I don't know what one's like, but I wouldn't say that's there for its practicality. But Tesla's, I think Tesla's dominant. I think it's already got a lot of the market in terms of EVs. And if you look at the growth of Tesla, I don't see this necessarily slowing down. Do I think it's overvalued where it is? Yes. If it came back to the 280s, 270s, that would be somewhere I would be interested in it from a personal point of view, from a personal sort of investment point of view potentially. But I don't like it at these types of prices. I don't think that's a good price to be a Tesla trader. Yes, we're above the 50 moving average, which is great. Maybe the 360s, 270s might be a little bit ambitious. Maybe this kind of 360 area where we had this kind of one of my favorite patterns, sort of ascending triangle breakout. Maybe there around that area could be a possibility for some upside. But yeah, Tesla I think is got its own kind of backing from supporters rather than just people focusing on how its performance has been. There was some interesting data out last week, I believe, where it was talking about the cars that they'd manufactured was they didn't manufacture as much as expected. So the demand is slowing for Teslas right now. I think the demand for new cars, demand for cars in general, is starting to slow. If you look at the second-hand car market as well, prices have come down a lot since the spike in sort of 2020. where we had that kind of mad rush that, you know, even sort of big name car brands were trying to buy your car off you so that they had the parts and stuff, which was super interesting as well. But yeah, if you look at EV prices at the minute, you know, they're not doing well. A lot of EV prices are coming down. You know, I think if I go on to Tesla's website right now and have a little look at what Tesla is selling and what the prices they're selling at. So the first thing that comes up for me is a Model Y, but what I like to look at is, oh, you can get the Cybertruck in the UK now. Oh, didn't know you could actually get any in the UK. They've took the Model S and Model X is gone. I know they don't produce those anymore, but you can get them. But they're not on the website. So Model Y, what does that start at? £349 a month, but that is with a 5,000 down payment. I know BYD in the UK are doing 200 and I think it's for the Dolphin. They're doing it £289 a month, £289 deposit. So that's how they're going to capture the market. That's how they're going to take things, because the down payment that they're asking for is a lot cheaper than what a Tesla is. But that's come down a lot, I would say. I'm pretty sure to have a brand new Model Y a few months ago was like £600-700. Pretty sure. So that, I reckon that's come down a fair bit. I'd love to see if there was like a website out there that showed you the price difference of the cars at whatever point. There probably is someone that's done that. Let's look at the trading prices. Certified pre-owned. I like to look at the... So Model 3s, let's go from high to low. Let's see what a 2024 model is. £57,000. I just don't know who's going to pay £57,000 for a brand new electric or a used electric vehicle. The thing is as well with electric vehicles, they give mad warranties on them, don't they? Because I know Tesla's got a warranty of like 100,000 miles on their battery. So, sorry, I've just gone into a deep dive of Tesla now, having a little look. There's a 2020 Model 3 here that's only done 33,000 miles and is going for 18k. So why would somebody go and buy a brand new one when you've got a 2020 model that's only done 33,000 miles? I think the only benefit in the UK is you don't have to MOT or service it if it's brand new for 3 years, I think. But even then, if you've got warranty to up to 100,000 miles, I just don't know why you'd buy a new electric vehicle right now. But yeah, BYD is battery drive unit warranty, May 2028, 100,000 miles. So you've got a battery and drive unit that has a warranty of 100,000 miles. You've got another 70k pretty much on that, or 67,000 miles. You've got used vehicle limited warranty of 10,000 miles, so pretty much a year. That ain't bad. See me driving a Tesla next week. Right, let's jump back to the markets then. I've just been waffling on about Tesla for a little bit, but thanks for the question, Just Nothing. I appreciate it. Let's go take a look at some of the data that's coming up then. Got a lot of data still to come towards the end of the week because it's NFP week. Who is trading NFP at the end of the week? That's what I want to know. Not me. From my point of view, do you trade NFP? That is something that I want to have a conversation about. Let me bring up the NFP seasonal chart. And let's see. So if you want to get the NFP seasonal chart, you can come over to something called equityclock.com. Come down here to economic data, click on employment. Okay, and then we need to see total non-farm payrolls seasonality. They've not completed this. They've not completed it. But 2023, 2024 had a pretty strong average. I bet you they haven't completed it because I'm pretty sure November was a pretty bad month. But January tends to slip off. January does tend to slip off in a big way. February seems to be sustained, and we usually get a bullish period of NFP numbers from February to June. So that's what we need to kind of watch out for this year. Are we going to see a very similar path of employment? There's a lot of things kind of bubbling in the background where we might not see that. You know, if Trump comes in with tariffs and he starts tariffing everything to the hilts, and then it causes businesses' costs to go through the roof. You know, maybe interest rates even move higher as well. You know, there's a possibility that that could happen depending on how it impacts the likes of inflation. If that's the case, then, you know, businesses may start to reconsider hiring for one, and they may start to reconsider laying off, or they may start to consider laying off staff. So that could be pretty bad. One thing that I'm going to really keep an eye on, unemployment rate. Okay, this is something that I want us to really focus on going into this trading year in 2025. Keep a close eye on the unemployment rate. Okay, 5% is a big no-go. 5% and above, do not want that at all. Okay, do I think we'll get there? Not yet. You know, it might even be towards the end of the year when we start to see a real uptick in this. 4.2% is okay. It's sustainable. It's fine. You know, I'll start to get worried if this starts to print sort of 4.7, 4.8, then I'll really start to get worried about the unemployment rate in the US. But until then, I think you're probably all right on that. But I will be keeping an eye on this. If we have a little look at sort of 2023 to 2024, the average of the unemployment rate is starting to creep up a little bit. Okay, we are starting to see a creep up in the average of the unemployment rate. So I would be very, very cautious going into this year, because if we start seeing higher unemployment rates, then I think that the stock markets could have a pretty bad year. You know, the last time we really saw that happen was in 2020. Obviously, COVID, we saw a lot of layoffs, a lot of uncertainty. Then, you know, people realized it wasn't probably as bad as what was expected, and we saw that kind of normalize a little bit. But you know, the other time that we saw that was in 2008, 2009. You can see we started to creep up towards that 5% figure, and then after it kind of broke that 5% barrier, it went on this exponential rise because that was the recession, and then it kind of peaked December 2009, and we started to see readings that came lower, and obviously the market returned to normal in those conditions. We saw a very similar thing here in 2001 as well, where you can see above 5%, kind of see a little bit of an uptick there. So yeah, I'm going to keep a close eye on this going into 2025. Unemployment rate is going to be on my radar like a hawk. I'm going to be keeping an eye on that. So NFP numbers, what market could it really affect? You know, obviously it's going to impact the US dollar, but what market is it going to impact? Now, one thing we can be looking at is our volatility index. You know, if the volatility index spikes, what does that mean? Well, we usually see risk assets fall, and we see safe haven markets rise. So things like the Japanese yen, the Swiss franc could do a little bit better off the back of it. What else could we see? Maybe a little bit higher in gold. Usually see stock markets fall off the back of that move. And if we go take a look at stock markets right now, they're not having the best of time, right? If we have a little look on it on a weekly chart, we're definitely in that sort of pullback phase of the market right now. You know, just kind of pulling back here at the minute. So stocks not having the best moment, but it is still very early in the year. I still feel like stocks can rebound. but we'll have to wait and see whether it's going to be another stellar year. I don't think we're going to see a 2024-2023 move, because if we look at how much price has moved, let's take kind of high to low. So the low in 2023 was around 3,800, and the high in 2024, that's a 60% rise. Now, on average, the S&P usually is around 10 to 13%, the average. So that is smashed the average to pieces. So do I think we're going to see 2025 as a year of strong bullishness? I don't think we will. I think the situation with Trump and tariffs could actually have a bit of a deeper effect than what's going on. I mean, Trump's already kind of thrown his hat in the ring as well, hasn't he, with regards to talking about interest rates. He wants the Fed to lower interest rates. Of course he does, because he wants to tariff everybody. So he wants the Fed to lower interest rates so people can keep spending. He doesn't want the consumers to be impacted. He wants to kind of balance it out. So he's pressing for the Fed to cut rates. I don't think we're going to see that. If we just pop onto our CME Fed Watch tool, the chances of a cut on the 29th of January, so you can see 29th of January up here, 93.1%. And I think if we see stronger NFP numbers as well, I think this will just cement that we're going to see no change there. Good afternoon, Vincent. Hope you're doing well. Good afternoon as well to Alphonsus and Zero Trading. Welcome. Hope you're all doing very, very well. So, yeah, I think if we even kind of scope out towards when the next hike could potentially be. So March, we've got a bit of a 50-50 situation going on here. May was skewed more to easing at the minute. There's 56.7% chance that we could see in May. We'll go have a little look at the dot plot. Okay, so the dot plot is telling us where the rate could potentially be in 2026, and it's looking around that sort of 3.75% area. And the current rate at the moment is, of course, that sort of 4.5. So I just think that it's quite interesting to see that they're only expecting a little bit more in the way of cuts coming up, and that's also being priced into your bond market, right? So one other thing, or one other story that we should really keep our eyes on as well, is your US 10-year yield. Okay, now if we overlay the US 10-year yield and the US dollar index, I'm actually going to get the futures, dollar index futures, and we're going to add the DX to compare, pin the scale to the right. Okay, usually this has this does have a positive correlation. So when we see bond yields pushing higher, the US dollar tends to push higher. When you see bond yields fall, then you usually see the US dollar fall as well. But we're coming up to a very strong level in the US 10-year yields, which is the 5% level. Okay, so if we do see prices come into 5%, what happened last time there is that we saw quite a strong rejection of that, which then obviously also led to the US dollar moving lower as well. So I think if we get into that territory of 5% and we reject 5%, then we also could see the US dollar start to roll off as well. So, I think the US dollar trade at the minute is a cautious one, simply because we're approaching these sort of significant levels, which is, for me, 5% up here is a critical level. for the US 10-year yields. We're also at another significant high at the moment, which is that sort of 4.7% where we've been before, and we've seen a sell-off in those bond yields as well. So that's something to keep an eye on. If we go take a look quickly as well at the commitment of traders reports. One thing that we were really keeping our eye on last year was the 5-year Treasury notes, because we had 100% buy signal on the 5-year US Treasury notes, and we were looking to see if we were going to see a bullish move down in these kind of levels here, which was through November, and we did start to see a little bit of it, but it never followed through. And we had, if we look at the net positioning on the 5-year notes, they were at levels that we have never witnessed before. Okay, so that means hedge funds were selling sort of T-note bonds at levels we haven't seen before, and commercials were buying them at levels we'd never seen before. So usually that does lead to a reversal, but we had the reversal for like 2 or 3 weeks. It wasn't sustained. Prices didn't really continue to move higher. In fact, they started to sell off again. So, they could continue to sell off in the short term, which would see the US bond yields move higher, which would probably bring us into that 5% level when these kind of reach that 105 points there. So that's something to also keep into effect. Maku, what of CAD Swiss in regards to a new prime minister after Trudeau's resignation? I think it's going to be interesting to see what happens to CAD at the moment. For me, we saw a little bit of CAD buying when it was announced that Trudeau was resigning. If you go have a little look on the daily chart here of CAD futures. So we had the sort of resignation, and that was seen as a positive. But CAD at the moment is very, very much a weak currency right now, in terms of just if we look at the CAD futures here, this CAD futures chart. Why is that? Well, you've got this kind of political unrest, and then you've also got the fact that Trump is trying to kind of merge America and Canada. I think at the moment he's also trying to merge it with Mexico, I think, by the sounds of it. But he's also, he was expected to tariff Canada quite heavily, which Trudeau was against. So it depends who they bring in, because the Conservative leader in Canada at the moment is one that would probably side more with Donald Trump, and I think if that's the case, then it could be positive. The only other thing that CAD's got going for it at the minute is that oil prices are starting to move higher. So have a little look at our oil prices here. We can see that we've broken out of that kind of range that was at sort of $72 towards that $66 range. We started to break out of that. So yeah, there's a potential here for the market to move higher in terms of oil prices. I think if oil prices do well, then CAD might have a little bit of a revival. I also kind of look at it and say to myself, who's selling CAD futures down at this level? If you were looking at a chart and you were like, where do I want to sell it? You wouldn't want to be selling it down here. If we go look at the weekly chart, these are the 2020 lows. Now, I'm not saying just because of that price is going to move higher, but it would definitely be a factor that I think about when it comes to value. Risk reward. Is this a good place to sell CAD futures? No. Now, when I say sell CAD futures, what I'm talking about is selling dollar CAD basically up at these levels. But I think we just need to wait a little bit longer. We need a catalyst. Maybe NFP might be the catalyst that gives us the move. I don't think it will. I think we're going to probably see this dollar dominance until Trump is announced, and then we might get the rollover when Trump's announced. But we'll have to wait and see. Because we've got, what day is that? That's the 20th, isn't it? I think it's the 20th of January. So I kind of like your theory on CAD Swiss. I like the idea of shorting the Swiss franc at the moment. I mean, CAD Swiss is in a bit of a range. One market I really like. Pound Norwegian kroner. Now, this might be one that you're thinking, I don't trade that. But this is a market that I quite like the look of. This was a Euro NOK was another market that I really liked earlier in the year as well. We were talking about potentially shorting at these levels here and these kind of resistance levels, and that worked out pretty well. We just didn't see the follow through that I was expecting. But the difference between Norway and the UK at the moment is quite different. Norway obviously has the backing of the oil prices moving higher. If we see oil move higher, then the Norwegian kroner is a market that strengthens. If we go take a look at, if we go back to here, let me just get GDP up. Okay, so Norway GDP has come down to minus 1.8%, but it was up at 0.4%. I actually didn't see that it come down to minus 1.8%, but GDP has come down a little bit. So the GDP differential is not the best there then. Let's have a look at the inflation. You know, the best thing to do is actually go this page here, scroll down to here, click the plus button. Where are you, Norway? Norway, okay, 4.5%. I didn't see that their GDP had come down that much. So interest rates at 4.5%. The UK is at 4.75%. So very, very close there. But Norway's not looking to cut interest rates at the moment. 2.4% in differential there on the inflation. Where is the inflation rate in the UK? 2.6%, so slightly higher there. Let's go to Norway. So you can see that Norway's economy really does rely on oil prices. Okay, 79% of what they do is oil. Oil prices are moving higher, so that should have a good direct impact on what's going on in Norway. Okay, they import a lot of vehicles. Vehicle prices have been going down. Imports by country. Let's see where they're importing from. Sweden, China, Germany. Well, they're going to get cheap products from China at the moment. They're going to get cheap products from Germany, to be honest, because the German economy is not doing pretty well either. Let's have a little look at what happened to their GDP then. See if we get an explanation here. Quarter on quarter, and after following a revised 2% expansion on the previous period. So they did get a revised 2% in the Q2 of 2024 in the year, the steepest since the second quarter of 2020. Wow, that's quite a big change then, primarily driven by a sharp decline in petroleum activities. There you go. So the decline in oil prices really impacted them in Q3 of 2024, but you can see that that's starting to grow higher, right? Net also weighed on GDP as exports fell to 4.4%, expected to be 6.2% in growth, while inputs also declined more modestly at 0.3% versus 4%. Additionally, growth in government spending slowed, household consumption stagnated. On the other hand, fixed investment growth accelerated. Year-on-year GDP grew by 3.5%, down from a significantly higher revised 5.4% expansion in the previous quarter, which had been the fastest pace of growth since 2021. So it's actually quite a mixed bag there for the GDP in Norway, which is surprising. I thought that they were actually doing pretty well, but I hadn't actually kept up with what was going on there. Q3 of 2024 minus 1.8%. So we'll see if that grows, because if you do grab a US dollar NOK chart, and come down to, where's my energies? Okay, what is all this down here? So I'm just going to use Brent prices, because that's usually more to do with the Norwegian krona, regular. Okay, I need to pin that to the left there. So we've actually had a little bit of a disparity between the dollar NOK prices. So dollar NOK's obviously moved a lot higher. Usually these two markets correlate pretty well. But stronger oil prices here should see dollar NOK perform a little bit better to the downside, really. That's an interesting one. Maybe I have to revise that. I'll have to have a little look into that a little bit deeper then, because I thought Norway was doing a lot better in terms of GDP growth than what they actually are, which is something I need to have a little look into then. I didn't catch what you said on GBP, Japanese yen, pound yen. I just like the idea of potentially being a seller of this market. You know, pound weakness is something I'm looking into at the moment. You know, and to be honest, the bond market is in a little bit of trouble there. So there's an opportunity, I feel, for pound to move to the downside. Japanese yen I quite like as a potential buy. It's a currency that has been getting stronger. If we just go take a look at the strength and weakness here, you can see that the pound -5, Japanese yen +2. If we go take a look at the strength meter as well, and just have a little look at what's been happening here. Pound is the orange line, okay, so you can just see it kind of coming down below that 0 line, which is this middle white line through here. Japanese yen, on the other hand, is the white line. You can see that it's starting to pick back up. So Japanese yen has been a weaker currency for a little bit, but you've got the sort of difference in policy here as well. So the Bank of Japan are potentially going to hike interest rates. We don't know when that's going to happen, but there's a likelihood that they will hike interest rates at some point. So I like the idea of potentially looking at yen on that point of view. But then if we look at the pound, there could be scope for a potential Bank of England to do something if we don't see any growth in the UK. So that's something I'm looking at. So I think that maybe we might see the Bank of England having to do something, maybe cut rates. And if the Bank of Japan are going to hike interest rates, if we see higher or a possibility of higher interest rates, because if we do see higher inflation in the likes of Tokyo, then the yen could get stronger. So I do quite like the idea of maybe seeing pound yen revisit 185. But at the moment, when I'm looking at this daily chart right now, price has made a lower high. We have created a new low. I need to see that confirmed, and then there's potential for the market to go through and push a little bit lower at that point as well. How long are the natural gas market movements likely to be influenced by ongoing recent political issues? Yeah, that's the problem with nat gas at the moment, isn't it? Especially when it comes to sort of Russia and Europe, because there's so many sanctions on Russia right now. But the problem is Europe are still buying from Russia. it's going to have a big influence on the price. I think, we've seen that happen for a while. If you look at the commitment of trader reports as well, they've been very bullish. Natural gas, and it makes a lot of sense. And now we're through this kind of 3.4 level. Where does that open up the door to potentially up at this 5? I think the natural gas story is going to be one that we hear a lot from over the next kind of few months. It'll be interesting to see how this turns when Trump gets into power and things like that, because I know that America are looking to put further sanctions on Russia as well. So yeah, I'll have to do a bit more of a research into how it's going to impact it further, what in particular will impact what. But I think for me, the situation with Russia or Ukraine at the minute doesn't seem to be slowing down, and it's been going on for probably a little bit longer than what everyone's anticipated. And if we have a little look at so I think Europe are probably going to try and do a deal with America to supply gas, I'm pretty sure. So at the moment, let me just see. So we used to, wow, it's actually dropped quite a bit since the war outbreak, but the share of Russia's pipeline gas in EU imports dropped over 40% in 2021 to 8% in 2023. So, that's quite a significant drop now. So we have a little look. And you can see here, drop was possible thanks to an increase in LNG imports from overall reduction of gas consumption in the EU. So you can see that Russia accounted for, nearly half of gas into Europe, then dropped to 78.8 in 2022, now only 42.9, and you can see that there is a move elsewhere. Norway's there we go. there's my Norway analysis for me. A lot of gas could be coming imported from Norway if natural gas prices move higher as well. There you go. Look, top gas suppliers in 2023. Norway and the United States were the top suppliers of gas in 2023. Norway provided almost 30% of all gas imports. So yeah, there's my Norway analysis there done for me as well. That's why I think that the Norwegian kroner could be a stronger currency. Largest importers: France, Spain, Netherlands, Belgium, and Italy. Gas is mainly used for power generation, household heating, industrial processes. Over 30% of houses are heated using gas. So, actually the political spin on gas now may have less of an impact because of the diversification of where they get their gas from. And you can see they said consumption of gas is starting to fall a little bit as well. So actually the political sway on gas actually might not have a bigger impact as what we anticipate at that point. But it's an interesting one to have a look into. Right, guys, I'm going to leave it there. We've done just over an hour. I only like to run these for about an hour, but thank you for joining me. Some interesting topics in the markets at the moment. We'll keep an eye on this silver position from earlier in the week. Gold prices starting to push higher as well. I didn't really get a chance to talk about those today. But oil prices also fairly bullish at the minute. Nat gas I expect to remain fairly bullish. Other markets that I'd be really interested in is cable, especially when you keep your eye on what's going on in the bond market. So even if you just have your screen up of the US 10-year bond yields, this rising to levels we haven't seen since 2008, and quite sharply as well. So keep an eye on that. It's going to be something to take into consideration going forward. So yeah, keep an eye on your bond yields across the board. One that we did talk about as well on Tuesday, Japanese yen bond yields up at significant levels as well. That could be something to be warned as well. So thank you guys. Appreciate you all, and I will see you on Tuesday. Cheers.